Hey guys, so I wanted to make a video on something that I think a lot of people don't really know, or they want to know what it is. So swaps. Essentially, what is swaps? So just to kind of summarize what it means, giving it a definition, a swap is an agreement between two parties to exchange a financial payment. So for example, banks charge swaps, usually whichever provider your broker is with, they always get liquidity from a bank and so forth. So they charge an overnight fee. So for example, one party might be able to agree to pay a fixed interest rate, while another party has to pay a floating interest rate, so over time. So swaps are used to manage financial risks, so they can bet on future price movements. They're usually traded directly between two parties rather than a stock market. So how does it affect you as a trader? Well, it's actually very, very simple and easy to understand, and you can avoid it because most companies do try to avoid, most individuals as well try to avoid trading swaps, but sometimes it's unavoidable, definitely if you're a long-term trader. But for scalpers, I know the majority of people, they don't trade swaps. So I'll show you two scenarios where you would trade swaps, right? So for example, let's just say that you took a trade over here, right? And for some reason, you saw some sort of price pattern and you were like, okay, cool, I'm taking a trade over here, and you went short. And let's just say you shorted it somewhere in here, right? Now you took this short position, and let's just say these are daily candles, okay? So if we look at the candles here, there's 1, 2, 3, 4, 5, and then let's call it 6, 7, and then 8, okay? So for 8 days you're going to pay swaps. So the swaps are very small, it's a small percentage off your position size, and yeah, they do vary depending on the size of your position, but you pay an overnight fee. So for example, if I open this position here, and let's just say management wise I had the position open around about there, this is when I might think, okay, let me get a little bit more aggressive, and then I've kind of left my stop loss around about here. So I've had it open for 1, 2, 3, 4, 5, 6 days, 7 days, almost taken out, and then I'm thinking, okay, 8th day I was taken out. So I was taken out on the 8th day. That means I held my position for 8 days, taking 1.63% profit, but also that means that the bank may have taken 0.2% off that position. So swaps is something that I think you should be aware of, that you do pay a commission for holding a trade overnight. That commission doesn't go to your broker, it goes from your broker to the bank, but sometimes brokers do charge an additional commission on top. It's just, yeah, it's one of those things. So keeping aware of swaps, because I've worked in a broker and I've seen people hold positions for years, and stocks especially. So with stocks, you might make something like £300,000 over a course of, let's say, a year on one stock, and then with that stock you might pay in swaps something like £30,000. So it could be 10% accumulated over that period of time that you've had to pay to, when you close that position, you've got to pay that in swaps. So that's taken from your profit when you close it. So swaps can definitely stack up on you, especially if you're in a sideways moving market, and this is the second scenario. So I'll just play this back over here, and let's just say that I took a position over here and I was in a short position and I just left it on break even for whatever reason. Now I've been in this trade for, let's say that's about 15 days, and then it just goes on and on and on and on and on, right? When I do take this break even, it's not actually a break even. It's hit me out at a break even position, but I've accumulated all of these swaps over that period of time. So what that essentially means is I've actually taken a loss, and that loss could be greater than my stop loss at that point, to be fair. And that's what people don't understand as well, is if I got in a position, somewhere down here, and I was in it for days, and then the position came up and tagged me out over here, and I took let's say a 1% loss. It's not a 1% loss at that point, it's a 1% loss plus all of those swaps. So yeah, that basically summarizes what is a swap, how does it affect you, and basically, yeah, just paying commissions, you can reduce them, you don't have to pay large commissions. People usually close their position on a Friday. You know, if you're trading things like crude oil, you should also be aware, check each individual instrument differently, because sometimes on a Wednesday, for example, crude oil might charge you double swaps, and then, you know, it's just yeah, it's a fee that you have to be aware of. So look into your instruments, know what you're trading, and if you're holding positions overnight, look into it, because I've also been on the hand of, when you're trading large capital, the swaps can stack up on you, and then you're thinking, oh wait, hang on a second, why am I paying so much commission? Why is my profit reduced from yesterday? Still in a sideways moving market, but your profit is getting smaller and smaller and smaller. So, you know, be aware of when you want to be in the market, when you want to be out of the market, and, you know, there's times to be holding and there's times to be getting out, you know, and that's one of the things that I think, if you're aware of that, then you'll kind of be able to refine your trading that much better. Also, don't forget to hit that subscribe and like button if you did enjoy this video, and if you have any questions, drop a comment below.